Welcome to Capital Connect, a podcast from Monark Markets dedicated to the most timely conversations in capital markets. My name is Ben, and I'm the co-founder and CEO of Monark. On each episode, I sit down with the investors, operators, and builders who are closest to the issues defining modern finance. I'm joined today by Paul Walker, an industry partner with Motive Partners. Paul is also currently the lead director of Here.io, formerly known as OpenFin. Prior to joining Motive Partners, Paul was most recently the co-head of technology at Goldman Sachs and a member of the partnership committee and firm-wide technology risk committee. At Motive, Paul works closely with portfolio companies on strategy and execution, which most recently includes a company we'll talk a lot about today called InvestCloud. Thank you so much for being here.
Pleasure to be here.
I'd love to start with your background.
Sure.
Maybe a good way of phrasing the question, did you expect to work in finance?
So, look, I first wrote a computer program for money in 1985, perhaps, when I was a teenager. And I knew I wanted to study physics, so I went and studied physics. I got a degree in physics, got a PhD in physics, studying the spiral and fall of colliding black holes, with that being what I wanted to do. And that's a dream that, when it meets the harsh reality of being an academic physicist, doesn't always survive. And for me, the reason I realized it didn't survive is the thing I liked about doing computers and physics was really hard problems, more than I actually liked the particular content of the surface mechanics of a black hole, which are interesting. But there are other interesting things as well. And so looking around for other interesting things to do, I found my way to finance. Did I always think I would work in finance? No. At the end of my PhD, was I excited to? Absolutely, yes. Because I thought it was a field with many interesting problems, lots of interesting applications of computing, especially in the 90s as derivatives markets were growing and the compute burden of doing risk management was increasing. And that turned out to be true. And so hopped over to JP Morgan briefly and then Goldman, where I ended up building the core risk system that we used for, well, by the time I handed it off to the next person to run that job, pretty much everything at the firm. When I started, it was FX and commodities and rates. And that was a really fun combination of all those things I love about physics as well. So did I expect to? I mean, obviously, the minute before I walk into my first job, I expected to. 5 years before that, I didn't. But I'm glad I did because it was a collection of interesting problems.
So you started in finance in the 90s?
Yeah, exactly. Late 90s.
Late 90s. What did technology and finance look like?
Well, so look, until about 10 years ago, 5 years ago, one of the two most advanced uses of technology was in the financial services sector. The other one was all the weapons lab stuff, which turns out to intersect. Relativistic fluid dynamics and my PhD thesis are not unrelated. So, I could have gone and done that instead, but I didn't. And so technology looked like the place where the absolute best technology was, which was super exciting, right? Tons of computers and, things that were supercomputing equivalent and real interesting math. And more importantly, the ability to solve those really interesting computational mathematics problems and see them turn into action right away. One of the things I spent a lot of time when I recruited physicists and other technical people into finance to share with them was, not only do you actually get to solve interesting problems, but if you get it really close to right, tomorrow someone will use it and give you feedback on it, right? That exciting feedback loop was really fun. I remember when I started to see consumer internet technology strip ahead of what we were getting at the banks. And now, of course, the biggest technology is not derivatives pricing. It's, the explosion we're having with these reasoning models that we're deploying in data centers around the world. But at the time, there was almost no more exciting place to do applied computing and applied mathematics. I think it was one of the most interesting places you could be at the time.
It's super interesting. I think we talk a lot about culture throughout the financial landscape now, especially our friends at Apollo talk about culture a lot. What was the culture like at Goldman?
2001 to 2017. The securities division culture in the 2000s is one I'm really proud to have been part of and a contributor to. A culture of excellence, of analytics, of innovation, of customer service, of profitability, all of those things rolled up into one. And there's a group of us, some of those people are still at Goldman, of course, and I have many colleagues there, but there's also a diaspora of people who were part of that community who are now at places across the street. So I think that culture in that moment in time of the trading businesses then is one that's been really fascinating to watch. And again, based on an understanding that you would really do interesting and good work and bring it to serve the client's needs as quickly as you could. It really kind of gave a sort of camaraderie. And, also, like, it's not the easiest place in the world to work. A little bit of sharp elbows here and there. That was part of the entertainment. So
A true meritocracy.
well, look, a true meritocracy. You heard this some sort of libertarian fantasy. Of course, there's other things that go into every job, and as one of my colleagues used to remind me, there's a reason they call it compensation, right? But a place where good ideas and good execution were well rewarded, right? And so that's a reasonable definition of a meritocracy.
And so now you're an industry partner with Motive Partners.
That's correct.
How did you stumble across Motive?
My career at Goldman, I was, as I mentioned, running a risk system, and I ran a chunk of prime brokerage. I ended up running the technology division there at the end of my career. And then in 2016, 2017, realized that was a fascinating job. I'm glad I did it. I don't regret it for a moment and proud of the work I did there. But I was looking for something with a different cadence. And so stepped away from that job and spent a year meeting people across the industry. One of the people I met was Rob Havert, who's the founder of Motive. I met him because a person who worked for me when I was working on the futures business turned out being Rob's first chief of staff. And so when he saw I retired, told Rob he had to meet me, just remembering the truest edict that, anyone can get you your next job. It's not always your boss. So he introduced me to Rob, and Rob had a really compelling vision, which is the combination of operating expertise and innovation mindset and capital to invest could lead to outsized capital returns. And I think that's proven correct with many of our investments. And so we've expressed that, he expressed that at Motive, and I've been an industry partner at Motive since before we had industry partners, an advisor there since the beginning. Expressed that with a collection of private equity funds and venture funds, co-investor relationships with large numbers of other pools of capital. And we've bought many interesting companies across the financial services industry through those, and have had operators, people with real operational experience, people like myself, actually work with those companies deeply, not just in diligence and not just at the exit point, but in the evolution between those points as well. And I think that combination of a sort of innovation mindset, a collection of capital, and the ability to bring real operational expertise to bear allows you to not miss a lot of things that you would miss if you were just doing a pure spreadsheet view or a pure operating view. It's a very interesting collaboration.
And so Motive is private equity fund and a venture fund today.
A collection of private equity funds and venture funds. Yeah.
Collection of. How would you describe the culture at Motive? I think maybe specifically one of the areas that Rob seems to lean into quite a bit is focusing on the brand that Motive has created and displays to the market. How does the brand impact the culture, and what is the culture like at Motive?
So look, the culture is one of expertise, of caution, innovation, and of risk-taking all rolled into one. So each of those. And, every different people have different roles and different expertises, and being able to bring those together to bear on a given problem is, I think, also a big part of the culture. I'm not at all a brand person. Rob is very good at it, as are many of the other people at Motive. But the brand we've been able to project into the market, I think, is commensurate with that we can bring real expertise to bear on a problem. Right? If we actually have a capital markets investment, you can get, me and another two people with the same sort of experience I've had to go take a look at it and bring their insights to bear, and not just affect the investment decision, but also be board members or embed in the company as an advisor for a period, like I'm doing with one of our portfolio companies now. I've done actually both those roles with our portfolio companies. And so I think that gives us a brand where we really do have a reputation in the market as being one of the smart investors at all light scales in the sector.
And Motive is specifically focused on financial services.
Financial technology, so insurance, payments, banking, capital markets, wealth management, and a data stripe underneath the entire end stack. Yeah.
Definitely unique for private equity and venture, but I think the focus has fairly led to positive outcomes for the portfolio.
Yeah, and look, these are scary markets to invest in for a couple of reasons. Every market is scary to invest in, but deeply technical markets, often regulated, often dominated by players who have a long history about how the market works. often with a reasonable amount of legacy technology that's still very important. Like if I think back to sort of the first fintech boom, it's before you were working in the industry, but I think there was a lot of folks who thought that technology was the answer to the fintech problem. And so you would miss things like gaps in credit, right? So you'd accidentally be giving a 2-day overnight loan because you didn't understand how settlement happened or something like that. And so I think what's happened with the new group of fintech entrepreneurs, including Monark and what you're doing here, is that you actually have combined that understanding of the technology and the plumbing and the operating, but you've retained that depth of information about real things in market structure, in operations, in regulation, in capital, in risk. And bringing those to bear across that portfolio with the expertise we have is, I think, one of the reasons we've been successful investors in the space as well.
And so you mentioned the operating partner model.
Mm-hmm.
Just explain to me what that actually means. These are industry partners, operating partners within Motive that are sort of deployed into portfolio companies.
Yes. So look, when you have a collection of senior people who are working in advisory capacities, there is no pattern, right? Some people have deep consulting backgrounds. Some people have deep operating backgrounds. Some people have management backgrounds. Some people have risk backgrounds. So there's a whole spread of folks. Essentially what it means is when we're making an investment or working with one of our portfolio companies, we can bring some of the foremost experts in a particular piece of context to bear. I don't want to sound humble, but if you're doing something in capital market risk or ops or technology, there are worse meetings you can get than an hour with me to talk about your problem, right? And for each of the places where we invest, each of the themes we have operating industry partner coverage that I think gives us that ability. And sometimes individuals become, leaders inside companies. And sometimes individuals go in and do things that look like deep consulting relationships or board leadership roles, right? I was on the board of one of our early portfolio companies that we sold. It was a risk management company that we sold to capitalists called Markets. And so that difference in the people, difference in the portfolio means there is no sort of formula for what an industry partner does. But expertise brought to bear on the portfolio, I think, is one of the key things that we grew.
We're here to talk about one of the Motive portfolio companies that you're involved in, InvestCloud.
Yep.
Talk to me about the story of InvestCloud, how it came together, and what InvestCloud does in the market today.
Sure. InvestCloud is one of our portfolio companies that was assembled by a collection of companies where it made investments. InvestCloud itself, the APL business, which is a managed account platform, and a few other digital wealth management businesses. And right now, InvestCloud has 3 lines of business. It has a digital wealth business, which is providing front ends and tools for digital wealth management. It's the business at InvestCloud I'm the least involved in, so please don't ask me follow-up questions about it. We have the APL business, which is a managed account platform that services about a quarter of all managed accounts in the U.S. wealth management industry. It's about $4 trillion of assets on the platform and continually growing. And we have the new business, one where I'm spending most of my time with my fellow Motive colleague, Andrew Tarver, which is our Altic business. And that is a business that is dealing with the consequence of wealth management platforms that have large numbers of customers wanting to invest in a subset of the private markets products, invest in evergreens and BDCs and other products like that, where frankly the operational pipes that we have wouldn't survive 25,000 trades at $50,000 ticket sizes coming down the pipe tomorrow with a rebalance coming in a quarter, right? And so we're tackling that problem because that's exactly the profile of the trades that happen in APL, where we have, again, $4 trillion of assets, but our average account size is, I forget exactly what it is, $800,000, something like that. Because these are people who have a wealth management advisory relationship, have a model-based approach to how they manage their assets, and because of the infrastructure of the industry are therefore functionally forbidden from accessing these private products. And so we're trying to tackle that problem with the third business line.
So we'll get to the thesis around private markets, but first I want to really take a step deeper into InvestCloud APL.
Yeah.
So it's a model management platform, model implementation platform with roughly $4 trillion of assets today. And APL sits behind what archetype of client?
Large wealth managers, wirehouses, people you would know who bring their individual wealth relationships through an RIA network, whether that's a independent or a captive RIA network, to their platform with models that they recommend, broker relationships that they recommend, so on.
And so for folks listening that don't understand what a model is, maybe just touch on what is a model portfolio and how do advisors utilize it in their practice?
Yeah, so we've talked about this before. One of the problems you get when you take a look at private markets is it's so wired to institutions and ultra high net worth individuals that we don't actually think about the wealth management profile of fairly rich individuals, where perhaps you have a few $1 million of investable assets. You have a relationship with an RIA, and that RIA has a model for how you invest. The simplest example would be 60% S&P ETFs, 40% treasuries, and then rebalance every quarter. They're obviously better than that, although that's not a bad one, right? In the case, that's a pretty good model, actually. They have these models that allow them to do sort of cross-cutting rebalances across their customers, but still give that advice and selection to the customer. And then there's an operational consequence of that. And the operational consequence of all of that is what the APL platform provides.
I like to think of models as sort of like programmatic trading in primarily public markets, where, to your point, a CIO or a strategist will create a set of model weights, like a 60-40 portfolio, and then a business like APL actually implements the trading of those model weights, sends orders to the market, it sends orders to the custodian holding that client account, and affects the rebalancing of the portfolio.
Yeah, exactly. The reason I hesitate to use the word programmatic trading isn't because it's incorrect. It is correct. But because just like wealth management, it's got an idea in the market about what it is that is at a different scale, not a different importance, not a different relevance to the customer, but a different scale than what would happen if you had a $2 million account, right? And so or $1 million account. And so I think, you're exactly right. That's what it does. And you're exactly right. That ends up limited to public markets today, mostly. But to think that we can take the same rule that we used for, a programmatic trading hedge fund and use it here, that's not what we're talking about, right? Just like the processing model that you use for a $50 million ticket for a institutional investor isn't the same one you want to use for $50,000 ticket comes from a wealth check.
Yeah, it's a good point. The real challenge is that the $4 trillion of assets is split up amongst millions of accounts that are all holding much less than $4 trillion of assets, maybe a couple $100,000. And each of those accounts need to be traded in accordance with the model simultaneously.
Which is easy to do in the equities market. And, doable in mutuals, doable in fixed income. And the way we've designed the privates market today, much, much harder. But essentially economically infeasible today.
So let's get into the thesis. I want to understand what is attractive about adding private markets to the InvestCloud platform, bringing private investment opportunities into these model portfolios.
A large part of the thesis at Motive is around essentially democratizing access to financial products, whether that's through a payments platform or whether that's through an open banking platform or whether that's through allowing people to invest in a broader class of securities. And so this matches the same thesis. The thesis is that the yields provided by private instruments are differentiated. They're uncorrelated or lightly correlated with public assets, maybe better performing than public assets. But also, I think many responsible investment advisors, which I am not, so, if this is not investment advice, but believe that it's an important part of a portfolio. It's an important part of my portfolio. And so the idea that here's a group of people who are making investment decisions and have wealth and can't access his exposure seems like one that's worthy of fixing. And I think the market is there with this as well. Certainly an interest from the supply side, from the people who issue the products, but also an interest from the demand side. Wealth managers and their customers are interested in how they get this different return profile in every regard, both correlation and amount, into their portfolios. So, in some ways, I understand why you asked your question. I think it's a very reasonable question to ask, but it's sort of a strange question, right? Why would someone want this product that we're selling in size to large parts of the world? Well, because it's a good product that we sell to large parts of the world. And if you believe that, then you should allow appropriately suitable investors access to it. That's the other thing I'd say as well, right? Which is we do have good suitability frameworks that we've developed in almost every part of the financial services industry. And that will be a reasonable guide for whether we should do this somehow. you and I both know that the liquidity profile of some of these things make them, you don't want to put your kid's college fund entirely in a liquid instrument 3 months before they go to college. But those sort of safeguards are sort of things that models and advisors already help clients with. And so there's definitely, I think, a part of the portfolio that is ready for and would be well served by access to a broader set of instruments.
So what you're describing really is a scale challenge.
Yeah.
Where the InvestCloud platform today manages all this capital in the public markets, and the thesis is to now bring some portion of private market, some percentage of that portfolio invested into private instruments,
Right.
Private securities. Why is that not possible today?
There's a variety of reasons, I think, that the market's not ready for that today. And most of those come from the fact that the market has evolved with very large tickets, with institutional or very high net worth investors. And so it's built an apparatus around that. That means things like document processing, legal reviews. Each of these things is well understood in the industry, and there are platforms that do it well understood for hundreds of trades, not tens of thousands of trades. When I said Andrew Tarver and myself and the rest of our team think about this, the way we're thinking about this is in some ways a different category of processing. We're not trying to make it twice as fast to sign a PDF, right? That doesn't solve a problem. But instead, we have to think a lot about what would actually happen if this was a scalable post-trade activity. And once you pose that question to yourself, you start realizing this is a path we've been through in many other situations, right? Jeff Yabuki, who's a Motive partner and is also the CEO of InvestCloud, spent a lot of time talking about the Visa network, where we went from inability to do payments to paper swipes to electronic payments. And how do we build that up? And now, when I was a kid, it would be ridiculous to think about buying a $3 item with your credit card. And now I realize I'm in Europe for 10 days and I haven't had any Euro cash in my wallet, right? That change happens, though, in a couple of ways. And we've seen it in equities as well and other trading with the introduction of SWIFT, and we've seen it in banking. You always start not with a technology solution, but you start with understanding what's the rule set and operating model you want to undertake. And so when I take a look at the way private markets are working today, the rule set, the implicit rule set they're using, and it is definitely an implicit rule set today, is based on a lot of manual labor and a low ticket count and a high ticket price. And so what we did with the InvestCloud team was we started by enumerating a set of rules that you would need in order to have a scalable trading activity. And that rule set places obligations on the network, on network participants, both as providers and sellers. And then once you have those rules, you have the job of going to wealth managers and asset managers and other parts of the infrastructure framework and saying, we can deliver you scale under this rule set. And then allow the industry to evolve, which is the same way that you set up central clearing. It's the same way you set up payments infrastructure. It's the same way you set up the Visa network. It's all things that many of us have done in different contexts, but to bring it to this context is yet another industry change. So the approach we're taking to that scale is begin with a rule set, implement a technology that implements that rule set, bring partners to the table from the suppliers and the consumers, bring the infrastructure providers to the table, start talking realistically about what the scale is, set up test environments, do test trades, publish rules, sign contracts, all those things. And that's the stage we're at today. With the goal of not just being able to 2x the trade volume, but really thinking about what 100x the trade volume or 1,000x the trade volume would look like.
It really is a transformative idea for the industry. One of the things I'm curious to get your thoughts on, another Walker, not Paul Walker, but Jake Walker at Apollo, talks a lot about the fact that there are so many different intermediaries in this sort of wealth management space today. You have custodians, you often have tech platforms facing an RA that are built on top of the custodian, a separate business from the custodian. Then, of course, you have platforms like APL that maybe implement models. You then have, on the supply side of the market, your fund managers.
Yeah.
Fund managers have transfer agents that maintain a system of record for their funds, often fund administrators as well. And so you sort of get the picture. There's a lot of different counterparties that are involved in the way that the ecosystem works today.
A lot of boxes and lines on the whiteboard. Yeah.
How do you think about, as you mentioned, sort of incentive alignment, getting everybody to play by the same set of rules. How do you think about approaching that challenge? Well, getting everyone aligned.
The way that we will start this is to invest in building these rules and network in conjunction with the wealth managers and GPs seeing what we're doing and understanding it, and the other infrastructure providers being able to participate in that with us for the benefit of the industry and the benefit of each of those participants. But look, one of the real risks is that everyone says no, right? I don't want the $16 trillion. I don't want my customers in these products. And we're fine with the product suite we have. Would be one of the things that counterindicates that strategy. So our strategy is based on the idea that there is a demand for the flow and demand for people to be put into the flow. Look, then there's just a lot of hard work, a lot of phone calls, a lot of meetings, a lot of building consensus, but also not just building consensus, but also understanding people's concerns and reasons for a lot of these things. I talked about the first fintech revolution in sort of their early 2010s. And a large part of that, from where I was sitting at the time, which was in the sort of bowels of Goldman post-financial crisis, I was a big chunker at that point. Why do we need clearing? Can't I just do X, Y, Z, right? Without an appreciation of why some of these facets of the market are real. And some of the things that we do really are important. I talked about suitability checks. Of course, we need to do those and support those and make those available and make sure that there's ability for the RIAs to understand what they're selling and so on. So none of that can go away. And so it's a nuanced, balanced approach to what do we change, what's in the new category, and what do we preserve and what do we bring over to that new category.
I've heard you mention in the past that you don't think this is a technology problem.
Right.
You think it's a network problem.
Yeah.
Why is that? And does AI have any impact on that point of view?
Yeah. So look, in the absolute most aggressive version of trade volumes that we could get from managed account platforms into privates, you get about 3 seconds of S&P E-mini trade in volume. Okay. So this is not a problem of can the computers process the trade, right? It's not a problem of do we have the right database record format. It's not a blockchain problem. It's not a database problem. It's a have we agreed on what the operating model is as an industry problem? And once we've agreed on that, then we need to stand up a piece of technology that can do it. The impact of AI has been really powerful because we're doing most of this post December 2025 when we got the first of the super advanced spoted models. And so now we're able to do this essentially as AI development first and use all those tools to their fullest, which is proving to be very, very powerful. We've done some really nice development work, especially work around matching the semantics of the rules with the operating model and the code and allowing coherence across all of those. That's sort of the holy grail if you're running an operating business, which is this piece of code returned false. Why did it return false? Can you track it all the way back up to rule 12.2 subsection 6s, right? Those things, that sort of semantic programming combined with coding start to become available. And so in many ways, the technology problem becomes less because first of all, we know how to build financial networks. Second of all, we know how to do database transactions. But third of all, the really hard part, which is then coding based off a set of rules, gets solved first of all by us taking a rules first approach, which we've done. And second of all, once we have buy-in on those rules and have built them, with having these new programming tools allow us to really be innovative, accurate, and testing carefully. And so, look, we're starting to do test trades now. I set the team the goal of the first, test client and APL through to a test endpoint by July 4th. We're going to get that. We're going to be doing real trades in the fall.
Amazing. So you started with the rules-based approach.
Started with the rules.
Technology isn't the main challenge. Technology challenge, but not the main one.
Look, I hope some of the team choose to watch this podcast. And Tom, if you're watching, the technology is hard, and we appreciate it. And Lee as well. Thank you very much for doing a beautiful job writing it. But when I say technology isn't the challenge, look, let me give you an example. So I was before I was at Goldman, I was at JP Morgan in the dot-com boom. And so I was sitting there in Lab Morgan. And when I was in graduate school, I was at NCSA and I'd done some super early web work. And so I got pulled into sort of thinking about the web with JP Morgan. And back then when we would get business plans for, readily anodyne businesses, I would like to, sell tractors on the internet or whatever the hell business was. And you take a look at the financial statement and it would always be, okay, brand, legal, blah, blah, blah. And then there'd be a line, build our own data center $50 million, right? For like every single little business. And we were just like, oh, I got to build a data center. Where else are you going to get a data center from, right? And then that all went away. And so now data centers aren't a problem. But of course, data centers are a problem. Someone's got to deal with data centers. Sure, we need them. But what they've become is something that is available to you on a sort of OpEx as opposed to CapEx basis, right? And in many ways, coding is shifting to that with these models. And so we still have to do all the careful testing. We still have to do all the design work. We still have to have an architecture. We still have to have a plan. We still have to have a product roadmap. But that 30% of the elapsed time in the olden days now becomes, 90% of the elapsed time, because then the 70% off, then someone gets it and starts stacking in Java code or whatever, TypeScript code nowadays, whatever people use, has gone away, right?
Getting back to rules-based approach, technology, what now is next for the InvestCloud business to really incorporate private market product into the APL platform?
Well, it's the work we've been doing in 2025 and 2026 is exactly that. We've built PMA Plus inside APL, which is a sleeve that allows all of the various nuances of getting a private product in there. So the illiquidity, the change between, buy and like there's a whole bunch of technical things that happen with cash management and when the NAV is struck. So all those problems are solved. PMA Plus is out there. PMA Plus then needs an execution venue, and that's what we're building in Altic. We're shipping all of that code, some of it now, some of it this year, to allow us to grow the private markets footprint inside APL for our customers. And look, that network product we think could also serve other sources of trades as well. Right? We're building Altic as a business line that is APL is our first customer, but certainly not APL is our only customer. So we're talking to other participants in the market as well about how they might be able to use the same network and the same approach to get access to these to this product suite.
Do you worry about incentives, going back to incentive alignment? Do you worry about potential InvestCloud competitors maybe not being as incentivized to use Altic? Or do you think that that's a hurdle that they're just going to have to get over as the industry scales?
I would love to be worrying about that problem. When we crack this, it's going to be a compelling pipe. We've designed it on purpose so that APL is the first but not the only customer. Because we've designed it as a line of business. Obviously, we need good things like data protection and, walls between teams, all those other things, but we know how to do those things. So I'm not worried about that. But our first priority is, we already have the largest customer in the world. So let's make them ecstatic with Altic before we worry about that problem.
I'm also curious the incentives on the GP side. You mentioned already that the broad incentive to get access to model portfolios is there for the GPs. That definitely makes sense. Maybe specific to the Altic network and InvestCloud APL, what has the feedback been from GPs? How are they thinking about the approach that you've taken in space?
Yeah, so I think the GPs understand now that there is a real processing problem in this market. They understand it clearly because there is. And the fact that we're showing up with a solution to solve it has been well received. We're not the only people who are talking about a solution to it, right? There's the omnibus work you're doing, I think is very interesting work as well. And I think there will be a few ways that different slices of this industry get tackled. But, well received with the idea of both we can bring you balances and we can bring you balances without your fax machine running out of paper, which is sort of state of the world today.
So maybe fast forwarding a few years, what would success look like for this project?
Success for this would look like a group of individuals who have wealth management relationships can get as seamless access to a group of private instruments as they do to anything else. They avail themselves of that so that well understood, secure and suitable balances go to GPs. And the network allows that operation to happen without adding 20,000 ops people to the industry. So there's a good measure of success.
That's a great goal to stay focused on.
Yeah.
My last question on this topic, there's obviously a lot of players in the market. There's a lot of players on the GP side. There's a lot of players on the distribution side. InvestCloud has a large client base today. How many players do you think you really need to get the flywheel turning?
I think we have enough between the GP relationships we have and the span of individuals who are AVL customers today and the infrastructure providers we're talking to, if they all decide that our plan is good and when they all come on board with these. And I think that will lead to more folks wanting to come on board, both as distributors and as wealth managers. But, I think this is one where the flywheel can start with smallish handful of GPs, smallish handful of wealth managers, few infrastructure providers, and a well-designed network. I think you can get quite a lot going.
Certainly at the scale that both InvestCloud and these GPs operate, I would agree with that.
Yeah.
I'm just curious your thoughts on, speaking about Claude, Fable 5 was released.
It was a fantastic 4 days.
It was definitely, for me, I made maybe 3 or 4 pitch decks in a few hours. The government, I guess, instructed Anthropic to shut down Fable for now, temporary pause, which seems to be creating maybe a new paradigm for how models get released in the future. What do you think about that?
Well, so I have no information on what the government did or why. And if I did, I wouldn't share it here, obviously, but I don't. So it's not like I even can. I don't want to make any comments on the current administration either. But I think it's critical that we understand that these models are going to be more and more an important part of the operating environment of many, many things we do, of our business environment, but also of our personal environment. And so, there's going to be an interesting question about how you govern them, how you manage them, how you risk manage them, how you release them. I think one of the most interesting things happening now is the uptick in open source models and how well they're doing. Right? If you could actually still buy a Mac with half a terabyte of RAM, you can actually do quite a lot locally. And I think we'll continue to see that evolve. But sure, how we think about releasing these models in every sense and the risk associated with them, I think is something we have to grapple with as a society. First time I touched a computer was 1978 when I was 8 years old, and someone showed me a Timex Sinclair with a chiclet keyboard, which by today's standards doesn't count as a computer at all, right? You should go look up the specs on the old chiclet keyboard Timex, maybe 1979. And so I had a TRS-8 Model 1 and Model 3 and a color computer it had access to. And then I remember when the IBM PC came out, and then all of a sudden offices had PCs, right? And so sort of revolution one for me was, and this is, how I made most of my money in high school and college, random small business where I grew up, got an IBM PC and had no idea how to use Lotus 123 or DBase 3, right? And so I was like, wow, this is cool. We have the future. We got computers. And I was at NCSA when the World Wide Web was invented, right? I'm like, wow, this is cool. Now we have connected computers. We got the internet. And both of those points are sort of moments in time where I think of a revolutionary change. And then, I remember when I first got access to a supercomputer and saw how fast it could be, right? And I'm like, there's a total difference in what I can actually do compute-wise. This moment is like one of those moments. This moment is a moment where the actual capability we have as human beings has changed because of delivery or a piece of technology. And I think it's a really important moment. And when you look through history at those moments, amazing things happen. Wonderful things happen. Humanity becomes better. And also weird and bad things happen. And so expecting both to happen and how we balance those, I think is going to be a very interesting part of the next couple of years. I'm glad to be working as a technologist at this time. It's really fascinating.
It is for sure. One of the first Wall Street books that I read was Flash Boys.
Oh, yeah.
And the story is, roughly that all of these high-speed, high-frequency traders were trying to move their computers as close to the location of the trade execution, the stock exchanges as they could. And how do you think AI as a new technology is going to change financial markets? Is it going to eliminate advantage or just change the playing field?
It's a nice little tiny question to end the interview with. Well, so first of all, that's an incredibly enormous question. And, if I sat here and I said I know the answer, it would obviously be a lie, right? The way I'm really thinking about these models is you have reasoning on demand. What, $3 a million tokens or whatever it costs, the API cost is now, and that reasoning is really, really, really good reasoning. We can argue about whether it's intelligence or not, whether humans exhibit intelligence, whether computers exhibit, I don't want to get into that argument. I think a large number of people writing about, consciousness and intelligence couldn't define those in humans or computers. But we now have a capability that we can pass a reasoning-like problem to a piece of software and get an answer back for $3. If we give it the right context, if we give it the right framework, if we give it the right guidelines, and if we give it the right environment. So just like if you went out and asked a random person on the street a question about financial markets without any context and without any information, you would get an answer that is, we're on Wall Street now, so you might get an okay answer, but you wouldn't get a great answer. Sending a question to a reasoning engine without appropriate context is going to be something I think that becomes not that useful pretty quickly. So a large part of, I think, what we're going to see is people who can grapple with context, who can understand context, and who can understand how to pose their business process as managing context combined with queries to a reasoning engine. Those people are going to have interesting things to do. And lots of exception processing, lots of advisory work, and frankly, a reasonable amount of previously non-automated operations work could fit into that. And almost all of the coding part of software development, I choose my words very carefully, the coding part of software development, not almost all of software development, but almost all of the coding part of software development falls in that category. Those are things that financial services, the operations, advisory, and coding part of software development is an awfully large part of the sort of cost side of financial services. So I think you would be remiss if you were, a board member at a bank or something like that, if you weren't thinking about this almost all the time. And so that's sort of the use we can all see in front of us, and you just have to go grab it. That'll change margins, but margins will compress prices and so on and so forth. So it will be a bit of a net pressure. I'm seeing a few very interesting things that are doing unexpected stuff with the models. And I think some of that will be unexpected, and when we see it, I'm not going to talk about any of that. Some of that when we see it come out will be could be very interesting. And the other thing I'd say is, look, what is it? It's June 25th, 2026 when we're taping this, right? Or 6 months and 3 weeks ago we didn't have Opus, right? And now like you can't code without it anymore, right? And so we're living at a time where sort of the rate of change is that an entire fundamental practice gets overturned with the development of a tool overnight. I have no reason to think that that's the last change we see. One of the mistakes I see people make is AI has gone like this. So what does this mean? Right? Forgetting that AI has gone like this. So the real question is, what does that mean? And so I have no idea. I just thought it's going to be fun. I hope it's going to be fun. It could be bad, but I think it'll be fun. And I hope it's going to be fun.
Well, I think that's a great place to wrap. Paul, thank you so much for joining me. This has been a pleasure.
Pleasure.
And I'm sure we'll see you back again soon.
Happy to help, and thanks for the invite. Great to be on the podcast.
Thank you so much.